Good afternoon, it's Jeffrey Christian. It's about 2:30 on Friday, the 9th of September, 2022, here in New York. I want to talk today about a variety of issues that have come up in the press, both the mainstream press, or what we would call real journalism, and in the darker corners of the precious metals internet. Tale of two markets, or maybe three. I'll talk about four types of topics. One is the state of the world economy. I want to talk about what I'm calling the Sino-Russian alternative currency farce. It's a joke. It's a joke, and most people know it, but precious metals, gold and silver promoters are taking it as if it's not only serious, but a fait accompli that will be introduced yet this year with effects on the market. Talk a little bit about silver inventories, because that came up in the darker corners of the internet. Somebody said that I somehow or other engaged in that discussion. And I'll talk about platinum market conditions, which is, I guess, the tale of a third market, or a third market view. So that's really what I want to talk about. And what I want to talk about is we exist at CPM Group in two quite distinct worlds, or markets. One is the real market, the real world. It consists of major producers, institutional investors, high net worth individuals, governments, academic economists, people who have a firm grounding in the reality of economics, politics, finance, society, and precious metals. The other world that we wind up getting involved in is the world of gold and silver promoters, conspiracy theorists, conspiracy believers. Hawk precious metals based on fear and conspiracy theories. True believers who really believe this stuff. I walked past JFK's house over on Fifth Avenue the other day. It's still around. And then people like me who look at the world and they see a lot of things that they don't like and things that ought not to be, and banks doing things for their own self-interest, and treasury officials under George W. Bush doing things that benefit their friends on Wall Street, but not necessarily the rest of the world, and other things. And I'll give you an example. In 2013, we exposed Andrew Maguire for what he is. He's a fraud. He never actually worked at J. Aron or any other bank as a bullion trader. He didn't really know what he was talking about. He had been leasing antique cars, including leasing cars to J. Aron traders in London in earlier days. When I did that, it was very interesting. I thought that major producers, the mining executives, would be happy that we had gotten this garbage out of the gold markets discussion. Most, all but one, didn't even know where it was. That's the real market. In that other market, in the parallel gonzo world, Eric Sprott jumped on Eric King World News that night to say that Andrew Maguire was one of the most respectable people that he ever knew, and that I was some type of scum. In one world, in one market, issues are solvable. In the other one, all issues will lead to global collapses and higher gold and silver prices. Someone asked me in a commentary once, why do we think that it takes a global collapse of the economy, the dollar, the treasury, the bond market, whatever, for gold and silver prices to rise? And the answer is we don't. But the purveyors of this schlock say that over and over again. And we've heard that several times just in the last couple of weeks. The dollar is going to collapse. The natural gas derivatives market has a $1.5 trillion margin call that it cannot meet, which is going to lead to a collapse of Western civilization as we know it. More and more stuff. And it's just stuff. Again, two markets, two visions of the world. One is reality. That's all I'm poor. And the other one is this dysfunctional dystopian future where everything has to collapse and gold and silver will rise. Now, the state of the global market and the global economy now, I'm going to give you a link in a second to Jeffrey Sachs, a fabulous economist who was very instrumental in reducing debt loads in the 80s and 90s when governmental debt loads had gotten too large. Extremely intelligent person, gave a wonderful 24-minute interview a couple weeks ago, which is worth watching. I'll show you the Foreign Affairs Conference thing. In terms of those natural gas derivatives and the high margins because of the spike in natural gas prices, the EU banks that finance those margins have all been taking steps to quell the problems, and it's a problem resolved. On the other hand, in the guns market, the global economy is close to collapse. The dollar is going to be replaced by something, yet this year or soon. Natural gas derivatives are catastrophic to the global financial system as we know it. The Chinese economy is imploding. And China are about to replace the dollar as the de facto reserve currency, probably yet this year. And the gold and silver prices are going to explode to the upside when one or all of these things happen. There's the issue of gold and silver inventories on the Comex. Just don't seem to understand. So the first thing is Jeffrey Sachs. Here's the link to the interview he gave with the Prague Finance Institute 2 weeks ago. Watch it. It's really worth seeing. He will talk to you about the world's conditions. And the title of the article is something like the problems of the world is in a crisis and it's going to get worse. He talks about the real policy proposals and actions that will deal with the crises that we have now and that are likely to get worse over the next several years. The truth is that it's not a choice between high inflation and recession or depression. There's a wide range of outcomes that could occur, that might transpire, and the highest probability are that the probable scenarios in the middle between monetary policies in the Fed and central banks. The real economy has a lot to do with it. Real politics, Russia's invasion of Ukraine and all of the ancillary issues there have to do with it. Fiscal policies matter, probably more than monetary policies. And the fiscal stimuli have been more than $1 trillion this year over last year, reducing some of those inflationary pressures, although increasing the risk of slower economic activity. Related to this, people ask CPI, why don't we focus more on the inflationary consequences of high monetary growth? All of these incredible increases in 2020 into 2021 of monetary aggregates, M1, M2, MZM in the United States and in Europe, these have to be hyperinflationary, people say. And we've explained repeatedly why we don't focus on that. There's a lack of a direct correlation. The historical evidence is that the inflationary consequences of high money growth in one period can actually be sterilized by subsequently tighter monetary policies in subsequent periods. We've seen that over and over again in 1982, 1987, 1991, 1997, 2001, 2008 to 2013. It's happened repeatedly since 1982. It's not as big of an issue as a lot of people seem to think. And Dr. Sachs can help us. The September-October issue of Foreign Affairs came out, and it's the age of uncertainty. And it's great. They talk about a lot of the things we've been talking about in these videos, including the future of China. And as some of you know, we have said that it's not inflation, or it's not the dollar, or it's not money growth that drives gold prices, it's uncertainty. Inflation and the dollar and money growth patterns are forms of uncertainty, but they're not the end all and be all. And gold prices rise and fall, as do silver prices, based on a complex mix of all of those uncertainties and others. And I'm happy to see Foreign Affairs has brought together a whole raft of discussions there. Now I know these are people who tried to install a one world government, but they didn't really. They got together to say, hey, let's talk about this stuff. And I will say, there are articles in the Foreign Affairs from time to time that cause my blood to boil. And I can't believe that people say that. And then there are other articles that say, boy, that guy that wrote last quarter caused my blood to boil. Here's the reality. When Joe Biden became president, Joe Biden said that the United States government was ready to reassume its stature as the leader of the world. Foreign Affairs had a lead article that said, hey, the world doesn't want the United States to retake its position as the leader of the world. The rest of the world wants the United States to behave as if it's a sovereign government in the midst of, 180, 200 other sovereign governments. Show some respect. Show some dignity for other governments and other people's ways of thinking about the world. Interesting stuff. Probably worth reading. All right, let's talk about the Sino-Russian alternative currency first. Now, that's part of a bigger thing. The dollar is going to collapse. You've been hearing that for decades. Central banks are going to call in all currency, probably yet this year. You're hearing that over and over again. And then the big one, the governments of Russia and China are getting together and they're going to replace the dollar as a de facto reserve currency. Now, it is true that Vladimir Putin has said that. It is also true that Vladimir Putin has said he would like to see something replace the dollar as the de facto reserve currency for almost 20 years now. And it's also true that almost everybody else in the world, in the central banking and treasuries and ministries of finance around the world, say, hey, at some point the dollar is going to pass away as the de facto reserve currency, and it will be replaced by something else. Talking about that for decades. In the early 1980s, I was working at J. Aron, and we were doing a large project on issues exactly related to that. And our client, which was a central bank of a major government, said, Mr. Christian, don't get excited. This is going to take decades and decades to unfold. And 40 years down the road, it's going to take decades and decades to unfold. And a new wrinkle has come in that there are indications that the dollar doesn't have to necessarily pass away as the de facto reserve currency. The U.S. government would do what it should do in terms of its fiscal policies. We could see the dollar remain the reserve currency for decades to come, and we could see other countries pivot away from saying we should replace the dollar as a reserve currency. And I'll show you some data about this. This is a chart. It's updated through March of this year of quarterly, it's the composition of foreign exchange reserves held by central banks. And you can see that back in 1995, it was about 58%. And you can see that in 2022, it's about 59%. It did rise from 58 to 70% over the period 1995 to 1999. And because central banks that had currencies that were had to get rid of those currencies. And they moved that money into dollars. They converted their Deutschmark and French franc and guilders and pesetas and everything else into dollars. And then after that happened and we saw the euro survived its first few years, you saw the dollar share of foreign exchange composition of central bank monetary reserves come back down to where it was prior to the changeover of the euro. Now, 60% in the dollar, percent in the yen, about 5% in the yen, 5% in the pound, and then 10% in everything else. Let me show you that. Claims foreign exchange reserves held by central banks in dollars, 58.9%. Hasn't really gone down over the last 5 quarters. In Chinese yuan, 2.9%. Oh boy, the ruble's not on here. No one seems foreign exchange reserves. Why is that? Sorry, I shouldn't be so sarcastic. Now, if you want to replace the dollar, and this is foreign exchange reserves held by central banks, in the private sector, it's estimated that between 70 and 80% of global financial wealth is denominated in dollars. So in order to replace the dollar, you've got to get liquidity up in those other currencies into a level where they can actually compete. If you do that, you say, well, okay, well, we have to a whole lot of Chinese yuan. You know, like go from 2.9% to 60%. We have to have a hyperinflationary yuan currency monetary policy that would destroy the Chinese economy. A long, long time before any of these currencies. I mean, the pound is the second largest. Euros at 20%, the pound is 5%, the yuan, the yen is at 5.4%. It's going to take a long time before any of these currencies are liquid enough to really have a substantial role as a major competitor for the dollar. And the governments of all of those countries know that that would be devastatingly negative for their economic activity, the way it was for the French when the franc was the de facto was the reserve currency of choice, the way it was for Britain when the pound sterling was the reserve currency, and the way it has been for the US dollar since 1945. They don't want their currencies to be the reserve currency. They would like to see a multipolar international currency regime, the same way they'd like to see a multipolar international political regime, an international financial regime, and an international social regime. So the idea that Mr. Putin's going to get together with Mr. Xi and say, let's get rid of the dollar and start using yuan and rubles, or maybe other currencies instead, is a pipe dream. He knows it. Most people in the real world know it, but that doesn't stop the gold and silver promoters from hawking it. Comex Inventories. I was amazed. I watched a video this week in which someone was trying to explain the difference between registered eligible Comex gold and silver inventories and how the metal goes back and forth. His lack of knowledge of the subject was astounding, but it was incredible that unlike his compatriots, he admitted that he system. He expressed a wildly inaccurate opinion that he wasn't sure that the metal was even in the Comex. He also said that he thought that it was quite possible, if not probable, that the inventory system was purposefully designed to discourage taking metal out of those depositories. Thousands of ounces, tens of thousands to millions of ounces a day that come in and out of those depositories every day. Millions of ounces every month. These are working depositories. Holding Comex registered stocks is actually a side business for them. Now, I just grabbed the most recent this morning, Comex silver inventories for September 7th. 823 bars had been taken out of or put into Comex depository. These are physical deliveries. This isn't a delivery of a warehouse warrant or a depository receipt to the Comex clearinghouse. This was 823 bars went into, physical bars went into Comex registered depositories on that one day. And 2,000 bars, that's 2 million ounces, were taken out. You had this clown car show a few months ago where all these conspiracy guys were saying, well, you know, we've been working for weeks or months to try to take a delivery of a bar. And clearly they didn't know what they were doing, or they were purposefully goofing off to try to make the point and make investors believe that you can't get silver out of Comex depositories. People take hundreds, thousands of bars out of the Comex depositories every single day. On average, I believe it's about 700 bars come in and out every day, millions of ounces, thousands of bars every month. And so that guy, he said, yeah, I really don't know what I'm talking about. And that's really good. Yeah, that's a good sign. Platinum market balance. That's the tail of this third market. This is data published by the World Platinum Investment Council, which is a group of South African platinum producers, and maybe some others now, trying to promote platinum for investors. And I put down here, this is their supply-demand balance. And like other promotional agencies, investment demand, dummy variables, in with fabrication demand, so that their surplus or deficit looks larger, or their deficits look larger and their surpluses look non-existent or smaller. And you can't do that. That's not the way to study a commodity market. We've talked about that ad nauseum. But you can see here, I have the data for 2020, 2021, and 2022. I have it from their March report. And then look at 2021, 2020, they were saying there was a deficit of 80,000 ounces, 88,000 ounces, including investment demand in with fabrication demand. Thought that in 2020, it went to 886,000 ounces, and they've revised that to 960,000 ounces. And they estimated that in 2021, it was a 1.3 surplus. So a 2 million ounce swing in the balance of metal from 2020 to 2021 in a 7 million ounce market. Yeah, more than 5% change shift, right? We adjust that data and we say, okay, well, let's take out the investment demand figures and let's put in, let's take out the investment demand. So then you have a 660,000 ounce surplus in 2020, as opposed to a deficit. In other words, a very large surplus in 2020, which helps explain why the price was really low, $800, $900 an ounce. And they've adjusted it down slightly subsequently. And their 1.2 million ounce surplus actually grows to, well, shrinks slightly to 1.2 million ounces. And they've adjusted that down to 1 million ounces. And then for this year, they have a 900,000. They had been thinking, well, the surplus would be about 650. Now they're saying 970, partly because investment demand is much weaker. Investor net selling of investors by investors is larger than they had thought it would be, and partly because fabrication demand is also lower than it would be. So that's a third view. But the world, there's really two markets there. These are our views. These are our surpluses and deficits, excluding investment demand. Total supply, including secondary recovery, less fabrication demand. And if you put this up against the price of platinum, it fits really nicely. Platinum price moves using our surpluses and deficits. The world is bifurcated. There's the real market, and then there's this imaginary market. I hope you enjoyed this. I hope you find it useful. Go see that Jeffrey Sachs video. That's 24 minutes. You can buy a copy of the Foreign Affairs September-October issue. I think you can get it as an ebook. It's really worth reading. You'll understand a lot more. I'll talk to you next week. Have a good weekend. Be good, be careful, be kind to others, and take care of the world for us. Bye.